So, all right, everyone. So what we're going to do today is we're going to start chapter 14, which is financial statement analysis. So what you're going to see in this chapter is that it's truly a culmination of everything that we've talked about up until now in terms of balance sheet, income statement. Now we're trying to do some analysis. So we're going to put you in the shoes of someone looking at a company's financial statements, doing some analytical procedures to understand how is the company performing from a variety of different metrics. So we'll talk about liquidity, we'll talk about solvency, we'll talk about profitability, and what do all of those terms mean. I really like this chapter. It is our last chapter in financial accounting. So that means that starting after chapter 14, starting with chapter 15, we move on to managerial accounting. I find some students really enjoy the managerial accounting section. It takes us away from debits and credits and journal entries and really puts us into the mindset of, if you are a manager of a company and you are looking at your business, what are some of the things that you're looking at? So financial accounting ends with chapter 14. The rest of the semester will be on managerial accounting. And again, I find that a lot of students actually enjoy the managerial accounting a bit more than the financial accounting. So let's go into some PowerPoints and we'll talk about some concepts from chapter 14. Okay. All right. So hopefully everybody at home can see the PowerPoints, chapter 14, financial statement analysis. So let's get started with some concepts. Okay. So as we know, general purpose financial statements, which are what? What are the financial statements that we've talked about throughout this semester? Balance sheet, income statement, cash flow statement. Stockholders' equity, exactly. So those are the four financial statements. And what we know is that investors, creditors, a variety of different types of users of financial statements want to look at the financial statements and understand what's going on with the company. So those financial statements provide a lot of valuable information. We know that companies that are public have to submit a 10K annually. And that 10K contains every bit of financial information that you would ever want to know about a company. As you know, it's voluminous. So really savvy investors take a look at a few different things to decide, how is this company faring? Are they profitable? Are they liquid? Are they solvent? So those are some of the concepts that we're going to talk about a bit today. But again, what investors and users of financial statements do is to be able to look at financial statements and understand how the company is doing. I'm sorry? Can everybody see the slides at home?
Yes.
Yep. Okay, so let's break down liquidity, solvency, and profitability and try to understand what these concepts mean. So we talked about liquidity before. Keep in mind, when we talk about liquidity, really what we're saying is the company able to pay its short-term obligations as they become due? So what we know is that typically companies pay their short-term obligations out of their current assets, right? So from a liquidity perspective, we tend to look at current assets in relationship to current liabilities. It's important to note that liquidity is a short-term measure. It is not a long-term measure. Solvency is a longer-term measure that creditors and other users will look at. But short-term creditors like banks, financial institutions are concerned with the short-term liquidity. Is the company able to make its payments of interest or principal, or can it make its payroll every week or every 2 weeks? Can it pay its taxes, its rent? can it pay its short-term liabilities as they become due? So again, most are interested in evaluating a company's ability to convert assets into cash. And again, that is referred to as liquidity. Long-term creditors like bondholders. So in chapter 11, we talked about bonds. So a company issues a bond. It's a way of getting capital in the door. So a company issues a bond to the bondholder. That bondholder is going to expect to get two things, right? What does the bondholder expect to get?
Dividends.
Not dividends, but just interest payments, right? So if you're the company, you issue a bond to a bondholder, that indenture tells them that every 6 months they're going to get paid interest. So bondholders, again, because bonds are typically much more long-term, bondholders expect that they're going to get their interest payments and they expect that they're going to get their investment back at the end of the bond term. So Solvency talks about much more of a long-term focus. So bondholders, creditors, if a bank has lent the company money, they want to make sure that that company is going to be able to pay its interest payments and repay the face amount of the debt at maturity. So liquidity is a short-term measure that tells us, can the company pay its short-term obligations as they become due? And solvency is more of a long-term way that investors can see if the company is able to pay its interest and principal payments. Profitability is completely different. So when we're talking about solvency and liquidity, we're typically talking about the balance sheet, right? We're taking a look at current assets and current liabilities. We're taking a look at debt. Can the company pay off its debt as it becomes due? So solvency and liquidity are very much balance sheet focused, whereas profitability is very much income statement focused. So that's an important distinction to make. So if you are a stockholder, you are very, very interested in whether or not the company that you've invested in is profitable. Because typically what happens is if a company is profitable, its stock price should improve over time. Doesn't always correlate that way, but from a big picture perspective, companies' stock prices move as they become more profitable. So profitability is an important metric from an investor standpoint. So for all of you out there, if you ever own stock, you want to make sure that the company is profitable so that you can ensure or at least hope that the stock price will continue to move upwards. That's why you buy stock. You don't buy stock so that it can stay the same price forever. You buy stock with the hope that that company is well-run, profitable, liquid, solvent, so that the stock price can continue to grow. So again, investors mostly. So whereas liquidity and solvency are very important to banks and creditors, profitability is extremely important to investors. Okay, so that's an important concept. Okay, so how do we go about looking at a company to decide whether or not that company is strong? So are they solvent? Are they liquid? Are they profitable? Well, there's a couple of different analytical methods that investors can use, or banks or creditors, to understand what's happening with the company. So when we talk about analytical measures, we're really saying that you're analyzing the financial statements and you're pulling apart the pieces of those financial statements that most impact your decision in terms of whether or not you want to invest in the company, sell the stock, whatever. So there's a couple of different analytical methods. The first is those methods where we take a look at the balance sheet or the income statement and we compare it to the prior year. Maybe we compare it to the past 5 years to see what has happened to cash over the past 5 years. That gives us a sense of a trend. Trend analysis is very important, and that's part of an analytical method. Ratios express a financial statement item or set of financial statement items as a percentage of another financial statement item. Typically, when we talk about a ratio, all we're talking about is a numerator divided by a denominator to give us a ratio that can help us to understand the health of of the company. So return on assets, return on equity, accounts receivable turnover, inventory turnover. These are all ratios that we'll cover in this chapter that give us a sense of how the company is performing, either from a liquidity and a solvency perspective or from a profitability perspective. So both analytical methods and ratios can be used to compare a company's financial performance over time, or how does it relate to another company. The important thing when we talk about comparison over time is, again, we want to be able to take a look at certain measures of a company, whether it's cash, accounts receivable, inventory, maybe it's net income. But what we're doing is we're saying, how does it look over the past 5 years? So a comparison over time is for the same company and how is it performed in those specific areas over a certain period of time. So it helps us identify trends in a company's economic performance, financial condition, liquidity, solvency, and very importantly, profitability. Comparisons among companies. So a lot of times what analysts will do is they will compare the performance of a company to a very similar company. So that helps from it to understand if I were doing an analytical procedure in a comparison among companies, and I wanted to look at Walmart versus Target, that would be a very good analysis, because those are two companies similar in size, although Walmart is bigger, but similar in size, and they're in the same industry. What industry are they both in? Retail, right? So they both buy products, or they buy inventory and they resell that inventory at a higher price. So again, you would never want to compare a Walmart to a General Motors, because they are completely different companies. They do completely different things. Walmart's a retailer, it's huge. General Motors is a manufacturer, it's huge. They're both extremely large companies, but they do very, very different things. General Motors will have inventory on its balance sheet. That's very different because it's a manufacturing firm. So it's going to have raw materials, work in process, finished goods, because that's what you see in a manufacturing company, whereas in a retail company, you don't see those accounts. So again, you would never want to compare two companies that are not in the same industry. But comparison among companies is very important, as long as you make sure that those companies are within the same industry and within the general same size. Okay, so how can some of these analytical procedures, what are they, and how can they help us understand how the company is doing? So the first is a horizontal analysis. The second is a vertical analysis, and the third is common size financial statements. So let's take a look. So the analysis of increases and decreases in the amount and the percentage of a comparative financial statement is called a horizontal analysis. Each item on the financial statement is compared with the same item or one or more earlier statements in the terms of the dollar amount of the change, either increase or decrease from prior year to current year, and the percent of the increase or decrease. So let's take a look. So this is a great example of a horizontal analysis. So what are we seeing here? We're seeing a balance sheet. The first line on this balance sheet is current assets. So we have all of our assets, all of our liabilities, and we have our stockholders' equity section. So as you can see, we're showing a base year, which is 20Y5, a current year, which is 20Y6. And what we're seeing is the dollar amount of the change and the percent change. Okay, so we can see that current assets for this company, Lincoln Company, has gone from $533,000 in the prior year, we can also call that the base year, up to $550,000 in the current year, an increase of $17,000. It's also an increase of 3.2%. How do you think we calculate that 3.2%?
Well, you take the original number and subtract the new number from the original number and divide it by the original number or something like that.
Okay, so you're on the right track, but let's think of it as the base year, because the base year is the prior year.
Mm-hmm.
I can't tell you how many times students don't get this on the exam, and it's a very simple thing to remember. The prior year is the base year. The current year is the most recent year presented. So if I took the current year minus the prior year, I would see that there was a $17,000 increase. If I took the 17,000 divided by the base year, not the current year, I would find that the increase in current assets from year to year is 3.2%. Okay, so it's a very easy calculation, but you just have to make sure that you know you divide the dollar amount change by the base year in order to get the percentage change. But this is basically what a comparative balance sheet presented in a horizontal analysis looks like. So really what we're doing is we're saying, what is the dollar change and what is the percent change? So what I can tell you is that when you look at the dollar amounts, so if you didn't have the percentage column here, the dollar amounts aren't particularly helpful because the scale of the numbers could be quite large. And we don't really know if that dollar amount change is significant or not. The percentage change really helps us to analyze what's going on here. So if I didn't have the dollar amount change and I only had the percentage, some things which would definitely stand out to me. So from an asset perspective, what change stands out to you? Right, so long-term investments went down by 82,500 or 46.5%. That's a pretty big percentage change. So if I'm analyzing these financial statements, I can make the assumption that this company probably sold some of its long-term investments, right? That's the reason why investments would go down from year to year, is because they sold some of them. So I don't have to ask management if that's what happened. I can pretty much infer that that's what happened just by looking at that ratio or that percentage change. I can also see that property, plant, and equipment that went down by 25,500, but from a percentage change, it's only 5.4%. What's a reasonable conclusion as to why property, plant, and equipment went down by 25.5? It could be two things.
Maybe they sold land or sold old equipment.
Okay, so they sold some property, plant, and equipment, but what's another reason why that number would go down?
Depreciation.
Exactly, it's because of depreciation. So we know that every single year. So let's assume in this case that the company didn't sell any property, plant, and equipment. It would be perfectly logical to assume that that 25,500 decrease meant that the company depreciated these assets by another 25,500 in the current year. So I would expect to see depreciation expense on the income statement of 25.5. So what I can do is I can kind of look at these percentage changes and I can make some assumptions. Because again, I don't know exactly what happened. I'm not part of management. I'm not in the know in terms of what's happening with the company on a day-to-day basis. But if I put on my analytical cap, I can kind of make some assumptions about what has happened. We know that current liabilities went down 13.6%, and we know that long-term liabilities went down by 50%. So what do we think happened to long-term liabilities? Marcus, what do you think? Long-term liabilities went down? What do you think happened here?
Long-term liabilities went down. Maybe we sold some equipment that we had.
So not equipment, but think about if the company has a liability, that means they owe money to third parties.
Yeah.
So if that went down from year to year,
We paid off.
exactly. So we paid off some debt. Now I can also make the assumption that they sold investments, got 82,500 in cash, and with that cash, they paid off some of their long-term liabilities. So as you can see, you can start making some assumptions. We don't know for sure what happened, but it's very reasonable to assume that based on these changes, that we can come up with some idea of potentially what happened with this company from year to year. So again, we look down in the stockholders' equity section, and preferred stock hasn't changed, common stock hasn't changed. That means that they haven't repurchased any stock and they haven't issued any new stock from year to year, because those numbers stayed exactly the same. And we know that retained earnings has changed. This could be a combination of earnings for the company, less dividends that they paid in that current year. So again, a horizontal analysis, very easy to prepare. You're going to have to do it as part of your application assignment. But again, all you're doing is taking the dollar change, taking that dollar change by account or by line item and dividing that dollar change by the base year to come up with the percentage change. Any questions on the horizontal analysis? Okay, so this is a balance sheet. This is the current, so if you see here on the prior slide, the very top line is current assets. It went from 533 up to 550. This next slide shows us what are the components of those current assets. So again, it's the same 533 and the same 550, the same increase of 17,000 or 3.2%, but it tells us that cash increased by 39.9%. Is that a positive or a negative?
Positive.
Positive, absolutely. Cash is king. Companies need to have cash on their balance sheet in their checking account so that they can pay for all of those current liabilities as they become due. They have to pay their employees' salaries, they have to pay their rent, their occupancy expense, utilities, lighting, phone. So having cash is good. So the fact that cash increased from year to year by almost 40%, that could be a very positive thing. We know that short-term investments increased, accounts receivable went down, but again, I don't care so much about the numbers. I care much more about the percentages, because what the percentages do is they take the scale out of it. So if you were doing this for Walmart, you would be seeing numbers in the billions. So if you saw that dollar change from year to year, and it was a change of 400 million from year to year, but it was only a 4% change, then I don't really care about a 4% change. So the fact that we convert it to percentages helps us to put everything on the same basis. So again, this is just the horizontal analysis, but breaking down the current asset section of the balance sheet. So now this is a comparative income statement, again, on a horizontal basis. So again, all we're doing is we're showing the change from year to year, the dollar amount of that change, and the percent change. So we can look at some of these percentages, and a lot of these percentages are fairly high, right? So we see that sales increased by almost 25%. That is without a doubt a very good thing. Every company would love to have a 25% increase in sales from year to year. Doesn't always happen, but in this case it did. But their cost of goods sold increased by 27.2%. So the cost of selling these items increased by more than the sales did. Now, if we look at the gross profit, that's still a healthy gross profit. It's almost 20%. But what we can tell is that maybe the company needs to figure out how to control some of their expenses, right? Because if their sales increased by 24.8, but the cost of those sales increased by 27.2, maybe that could tell us that there's some inefficiency there. But the gross profit increase of 19.7% is significant. Selling expenses increased by 30%. Well, that makes sense to me, because if sales increased, you've got to have selling expenses to support the increase in sales, right? So selling expenses include payment to your salespeople, right? If they're on commission, you're paying them commission on those sales. It could be marketing, advertising expenses. Obviously, you need to incur all of those expenses in order to sell. So it makes sense to me that the company incurred almost a 30% increase in selling expenses, because it resulted in almost a 25% increase in sales. So that connection makes sense to me. If I saw that selling expenses went down by 20%, but sales went up by 25%, I'd be kind of scratching my head like, gee, how did that happen? How were they able to increase their sales without increasing their selling expenses? So it's that type of thing that we need to start thinking about and start making those connections to see if those connections make sense or not. So what else do we have here? Administrative expenses, which are all of those other expenses like salaries for the CEO, the CFO, all the occupancy expenses. So that went up about 6.8%. not too worried about that. But again, as you can see, these percentages and the way they relate to other line items within the income statement help us to make sense of really what has happened with the company from year to year. So again, just a straight up income statement, but presented as a horizontal analysis. Any questions on that? Yes.
You said to get the percentage, the difference divided by the base year.
Exactly. So calculate, so I always start with the current year and back out the prior year. So if you took the 1,498,000 minus the 1,002,000, you'd get 298. If these numbers were flipped, then you would have a negative amount and therefore you would have a negative percentage. But you always want to make sure you're taking this change as a percentage of the base year, which is the same thing as the prior year. You don't want to use the current year or you will come up with the wrong percentages. Okay, so this is, I'm not going to cover this, is just comparative, a horizontal analysis for the statement of retained earnings. Okay, so that's a horizontal analysis, and that's one way that analysts could take a look at a company's financial statements and start to make some assumptions about potentially what's happening. The next that we're going to cover is something called a vertical analysis. So the percentage analysis of the relationship of each component in the financial statement as a percentage of another component. So let's see what that looks like. So if you're talking about a balance sheet, if you're looking at a balance sheet and you're doing a vertical analysis, every line item in the asset section is going to be expressed as a percentage of total assets. And then if you're looking at liabilities and stockholders' equity, those amounts are going to be presented as a percentage of total liabilities and stockholders' equity. So let's take a look. All right, so this is a vertical analysis, very different than a horizontal analysis. And what this does is it presents every line item as a percentage of another line item. So for assets, every line item here, so for the current year, we see $550,000 of current assets. If we divide that by the total assets of $1,139,500, we would get 48.3%. Does everybody see how that calculation happens? So 550 as a percentage of 1,139,500 means that total current assets are 48.3% of total assets. Long-term investments of 95,000 represents 8.3% of total assets. Property, plant, and equipment, if we took the 444,500 divided by 1,139,500, we would know that property, plant, and equipment represents 39% of total assets. So we do that for every category. When we get down to liabilities and equity, every amount is presented as a percentage of total liabilities and stockholders' equity, which is the same as total assets, as we know. So current liabilities, 210,000 as a percentage of 1,139,500 gives us an 18.4%, meaning that current liabilities represent 18.4% of total liabilities and stockholders' equity. So now that we know how to do the calculations, now what we can say is, okay, well, current assets in the prior year represented 43.3% of the total, but in the current year represents 48.3%. So again, just showing us that as a percentage of total assets, current assets has improved from year to year. And that's always a good thing. You always want to have current assets because again, you know that you're using those current assets to pay off current liabilities. So some other things that we could look at, we can say, okay, long-term investments went from 14.4% of the total to 8.3% of the total. Again, it doesn't tell us everything, but it tells us as a percentage of the total that that number has gone down from year to year. So that's basically the calculation. So you should always get to 100% because at the end of the asset section, you would take 1,139,500 divided by 1,139,500 to get 100%, or you would add up all of these percentages to get 100%. Okay, so the math has to work. Any questions on the vertical analysis? Okay. So that's a vertical analysis for a balance sheet. Let's take a look at a vertical analysis for an income statement. Again, this is the exact same company, Lincoln Company, comparative income statement, 20Y6 versus 20Y5. And it shows us what are the percentages as a percent of total sales. So every single number on the income statement is going to be presented as a percentage of that very top line. So super important that you remember that when you're doing your homework. So if I wanted to know how much selling expenses, what percentage selling expenses were of the total, I would take 191,000 as a percentage of 1,498,000. So again, this top line is always going to be 100% because theoretically you're taking 1,498,000 divided by 1,498,000. The next line, cost of goods sold, you're taking 1,043,000 as a percentage of 1,498,000, and you're getting 69.6%. So again, on the balance sheet, you're taking every asset category, dividing it by total assets, every liability or shareholders' equity item, divided by that total shareholders' equity and liabilities. Whereas on the income statement, every number is presented as a percentage of sales, which is that very, very top line number. Yes.
So on the income statement, are we gonna have to recognize things that are going out, like cost of goods sold, so that we make it negative?
Exactly. Yeah, I'm not sure in Cengage if it's going to make you. I mean, I think it's going to make you put the percentage in as a negative. So any expense, cost of goods sold is an expense. So are selling expenses, administrative expenses. So you would expect to see those as a negative because they're expenses which come out of revenue. So if we just want to look at the bottom line at net income. So in the prior year, net income as a percentage of sales was 6.4%. In the current year, net income, even though the dollar amount has gone up, right? So 76.5 in the prior year to 91,000 in the current year, but we don't care so much about the dollar amount, we care more about the percentage. So what I care about is that net income in the prior year was 6.4% of total sales, whereas in the current year, it's 6.1% of total sales. Now, it doesn't seem like a huge decrease from year to year. However, that means that as a percentage of sales, what has fallen down to the bottom line has actually decreased from year to year. Not a great sign, but it's not a huge difference. So probably nothing to get really worried about. But we would like to see this number going up, not going down. Okay, so a common size income statement or a common size analysis rather, our items are expressed as percentages with no dollar amounts. And common size statements are very, very helpful in comparing companies within the same industry. So let's take a look. So here's Lincoln Company compared to Madison Corporation. So we're making the assumption that these are both companies within the same industry. Maybe they're both retailers. Maybe they're both manufacturing firms, but we have to make the assumption that they are similar in size and they're in the same industry. So we can look at Lincoln Company. Now, again, it's going to track like a vertical income statement in that top line is going to be 100%. And then all of those percentages going down are just comparing company to company. So I can say, well, gross profit is about the same for both companies, right? Gross profit is a very important measure because it's sales minus cost of goods sold. Gross profit is a huge concept because the higher the gross profit, the better the company can absorb all of those other expenses that they incur so that they have profitability from a bottom line perspective. So in this case, gross profit is about the same, 30% for Madison, 30.4% for Lincoln. Selling expenses are a bit higher for Lincoln. Administrative expenses are a bit higher for Lincoln. And then even if we look at the bottom line, Madison Corporation net income as a percentage of sales is 9%, whereas for, Madison is 9% and Lincoln Company is 6.1%. If you were making a financial decision about which company to invest in, you might lean more towards Madison Corporation right? Because it looks like maybe they've controlled their expenses a little bit more, or maybe their sales are a bit stronger. So, and it's hard to just look at one bit of data and make a decision. But what I want you to start thinking about is if you're comparing two companies, what are some things that you would want to look at to decide which investment would make more sense for me? So again, even if you just looked at the bottom line, Madison Corporation is doing better than Lincoln Corporation. Any questions on the common size? Okay. So this is just a checkup corner, but we're not going to be able to, this is just asking us based on some information to take a look and try to compare a horizontal and vertical analysis. And again, here we see the horizontal analysis, which is again, just taking a look at the dollar change and the percent change from year to year. And then we take a look at the vertical analysis, which looks at the percentages, and every line item is expressed as a percentage of the total. So you would always expect this top line to be 100%. Okay. All right, so analyzing liquidity. So remember we talked about liquidity, solvency, and profitability. Liquidity analysis evaluates the company's ability to convert its current assets into cash. And again, that's so incredibly important because if a company needs to make payment for its salaries, maybe it has to pay dividends, maybe it has to pay its taxes, they need to have cash on hand. So to the extent that a company is liquid, means that they, from a short-term perspective, they are quite able to pay their current liabilities as they become due. So liquidity analysis and liquidity ratios and measures focus upon a company's current position. So we look at current assets and current liabilities, accounts receivable, inventory, and maybe some other current assets. So today we're only going to look at the left-hand side under current position analysis. We're just going to quickly review working capital, current ratio, and quick ratio. So current position analysis, again, evaluates a company's ability to pay its current liabilities. The information helps short-term creditors like banks determine how quickly they'll be repaid. And what are some of the three key measures of liquidity analysis? It's working capital, current ratio, and quick ratio. Okay. So we've talked about working capital before. We've talked about it several times before, and we know how to calculate it. We simply look at the company's balance sheet, and we take the difference between its current assets and its current liabilities. And if we have a balance sheet, we know that we are able to do that analysis. So in this case, this is the same company. This is Lincoln Corporation. They have current assets of $550,000 in the current year, current liabilities of $210,000. Therefore, working capital in the current year is $340,000. If we look at the prior year, current assets of $533,000, current liabilities $243,000. Therefore, working capital is $290,000. So what we can tell just by looking at this liquidity analysis from a working capital perspective is that working capital as a raw dollar amount has increased by $50,000 from year to year. Now that's a good thing. That's a good sign. We want working capital to grow because that gives companies much more flexibility in terms of how much cash that they can have. So the working capital is used to evaluate a company's ability to pay its current liabilities. A company's working capital is often monitored. It says monthly, quarterly, annually. Sometimes it's monitored daily. If you're a small business, the only way you're going to be able to continue your business is if you have cash flow. If you don't have cash flow, if you have no ability to convert any of your current assets into cash, then you're stuck. And then you have to make a decision, how are you going to get the cash? And that puts you into a borrowing situation, which is not a bad thing. But if you don't have enough cash, if you're borrowing money to pay your employees, that's not a great sign. So liquidity is super important. Working capital is super important. But it's difficult to use working capital to compare companies of different size because all you're looking at is a dollar amount. So you can imagine if you're looking at a Walmart, you're going to be looking at numbers in the billions. It won't really tell you a whole lot. So putting that working capital analysis into a ratio form is much more helpful because it takes the scale of the amounts, of the dollar amounts out of the equation. It doesn't take it out, you need them to calculate it, but the percentages make much more sense than just a sheer dollar amount. Okay, so current ratio, very similar to working capital, but instead of taking current assets minus current liabilities, which is how you calculate working capital, in this case, you take current assets as a percentage of current liabilities. It's a much easier way to analyze liquidity. So current ratio, you're going to need to know this on the exam, current assets as a percentage of current liabilities. So what would those current ratios be based on the same information for Lincoln? Current assets of 550 in the current year divided by current liabilities of 210,000 gives us a current ratio of 2.6. So who remembers, what does that 2.6 mean? Yeah.
You have $2.6 in assets for every dollar you have in liabilities.
Perfect. So you have $2.60 of current assets with which to pay off every $1 of current liabilities. In the prior year, that amount was 2.2. It means they had $2.20 of current assets to pay every dollar of current liabilities. As long as this number is over 1.0, the company is in good shape. If it's less than 1.0, like 0.8, that means that the company does not have enough current assets to pay its current liabilities, and that could be a problem for a company. But current ratio is just current assets divided by current liabilities. So again, the current ratio is a more reliable indicator of a company's ability to pay than working capital, and it's much easier to compare across companies because again, when you're just looking at dollar amounts, which is what you do for working capital, it's not particularly as helpful. Okay, and the last slide I want to cover is there's another ratio very similar to the current ratio called the quick ratio. It's also referred to as the acid test ratio. And what I can tell you is that the quick ratio is much more conservative than the current ratio in that it does not include inventory or prepaid expenses. So really what it's saying is your numerator of current assets is much stricter than it would be for the current ratio. So for current ratio, you're taking all current assets, cash, accounts receivable, inventory, prepaid expenses, whereas the quick ratio, you're simply taking accounts receivable, temporary investment, I'm sorry, cash, temporary investments, and accounts receivable, but you exclude inventory and prepaid expenses. So if you're given a balance sheet and you're asked to do a current ratio calculation and a quick ratio calculation, the only difference between those two is that for the quick ratio, it's a much stricter measure, meaning that it's only looking at those most liquid assets, which are cash, accounts receivable, and temporary investments. So quick ratio, instead of the numerator being current assets, it's quick assets. So in this case, the quick ratio for Lincoln Company and Jefferson Company, because again, we could make this comparison. For Lincoln Company, we're only using our quick assets, which are cash, temporary investments, and accounts receivable. So our quick assets are 280,000 as a percentage of 210, which is our current liabilities. So our quick ratio is 1.3. Now, you may not remember, but for the same company, the current ratio was 2.6. So 2.6 is much higher than 1.3, but the 1.3, sometimes investors want to take a look at that to see, okay, if we're only looking at those really, those most liquid assets, how much cash does this company really have? So you could always expect the quick ratio to be lower than the current ratio. This case, we know that Lincoln Company is 1.3, meaning that they have $1.30 of current assets to pay every $1 of current liabilities. Jefferson Company, on the other hand, is at 80%, meaning that they only have 80 cents of current assets to pay off every $1 of current liabilities, which means that it's just not enough. They don't have enough, and they could find themselves in a cash crunch if some of those current liabilities all became due and they didn't have enough cash or liquid assets with which to pay. And at that point, they either have to go to the bank or they have to find some way to get some cash. But again, if you're in a position where you're borrowing money to pay your employees or to pay your rent, that is a warning signal for a company. You need to have that cash on hand for those liquid assets on hand. Okay, so that's pretty much where I wanted to end today. This is where I ended with the other section. Any questions at all on what we've covered? Okay. All right. So again, the motivation assignment for chapter 14 is going to be due on Tuesday. Hopefully everybody got it.